How does one define microeconomics? Microeconomics is a part of the social sciences. It seeks to examine decision-making, motivations, and incentives that impact the utilization and distribution of resources. Microeconomics expresses how we attribute value to various goods and why. It seeks to explain how businesses and individuals derive a benefit from the efficient production and exchange of goods and services. Economic topics are determined by scale. A systems-level topic is macroeconomics. A microeconomics topic relates to individuals, such as how rent ceilings impact the supply of apartments. A question that might be explored in microeconomics is to determine the number of workers employed by Intel. Microeconomics does not address certainty, but rather the tendencies of choices. Responses are informed by changes in prices, availability, incentives, quality, and method of production. These responses differ between constituents such as producers, buyers, and sellers. These groups all have needs and wants, creating what is referred to as supply and demand. The demand for a resource and its available supply will determine the value placed on it by the constituents. If the demand is high for an item and the supply is low, the value or price of the item increases. This is called inflation, where too much money is chasing too few goods. If the supply is plentiful, such as increased oil production, the cost of oil goes down. These conditions are predictive but not a certainty, as other external factors such as government policy can skew the predictive model. How does an economist go about their work as social scientists and policy advisors? Economists do not conduct experiments, but they still work with data and generate positive statements, using facts that cannot be refuted and normative statements about how the world should be. Microeconomic ideas and problems. A common problem is the issue of scarcity with high demand. Scarcity, simply stated, is the limited quantity of a resource. All economic questions are about how to cope with scarcity. A second issue is opportunity cost. If you spend your assets on one resource, one will not have the money for another. When gas prices go up, individuals and businesses alike have to adjust their budgets to compensate for their increased cost. Economics is therefore concerned with the efficient and fair allocation of available resources to satisfy a want or need. The three main issues are what to produce, how to produce, for whom to produce. Monopoly. When a single provider of a desired resource emerges, they have the power to set prices. With a competitive environment, the market sets the price. Monopsony is where a competitor pays less wages or acquires raw materials at a much lower rate. This creates a de facto monopoly by underselling all other competitors. Government regulations have been enacted to bust up monopolies such as AT&T in the early 1990s. Volatile prices. Agriculture is particularly sensitive to volatile prices. If there is an abundant harvest, the increased supply can lower the price paid to farmers, putting many at financial risk. Those that have invested in agriculture can see fortunes made or lost in a single harvest report. This can lead to irrational behavior. Irrational behavior. Market frenzy is a phenomenon where individuals and institutions are motivated by emotions or incentives to chase market increases or to flee decreases. The Dutch suffered from a frenzy to purchase tulip bulbs from 1634 to 1637. People traded real assets such as currency and even homes to acquire tulip bulbs. When the bubble burst, many lost all. In the United States, a property bubble burst in 2007, destroyed the real estate values. Equity positions in most homes were decreased, leading to an oversupply of homes on the market no longer worth what was owed on them. Unemployment. Negative growth leads to reduced demand. Reduced demand means reduced production and loss of jobs. 2/4 of negative growth is defined as a recession. This creates an imbalance between the supply of workers and the demand for their skill. The economic and personal implications reverberate across the system to create a downward spiral. Inflation. When prices rise faster than wages, the buying power of a dollar decreases. It takes more money to buy the same items. This can create budget shortfalls. Many respond by accessing credit at a time when interest rates are increasing, further exasperating the situation. Trade deficits. When the import of goods is greater than the export, there is an imbalance. This is called a trade deficit. After President Clinton signed the China Free Trade Agreement, the U.S. exported only $3 billion in raw materials, while China imported $250 billion on goods. This created a trade deficit that saw manufacturing jobs move overseas. Exchange rate volatility. The euro currency tied country economies together. When the policies of Greece and Portugal ushered in a collapse of their economy, other nations, such as Germany and Britain, had to loan them billions to stabilize the currency. This later led to Britain leaving the European Union in a move called Brexit. Summary. Individually or in combination of these issues can negatively impact an entire economy or even the world markets. Proper policy decisions can help mitigate the effects of a down cycle. The ideal case would be to have competent managers, timely information, and conservative spending to avoid creating the issues. Production of goods and services. Goods and services is any tangible asset, intellectual property, or labor expenditure resulting in the exchange of resources. There are 4 factors of production: land, labor, capital, and entrepreneurship. Land, for the sake of production, can refer to agriculture, natural resources, and commercial real estate. Land that is cultivated for crops increases its value and utility. Commercial real estate, such as Walmart shopping centers, generates income from tenants of adjoining stores. Mining and oil are 2 natural resources derived from land, as is forestry products. Labor is any effort made by an individual to bring a product or service to market. Labor does not mean just physical endeavors, such as construction. It also includes jobs like programming and engineering. Capital is more commonly referred to as money. Money has an indirect impact on production as a means of acquiring the needed resources to produce an item or provide a service. As a factor of production, capital refers to the purchase of goods made with money in production. For example, a tractor purchased for farming is capital. Along the same lines, desks and chairs used in an office are also capital. Entrepreneurship. Entrepreneurship is the spark that ignites an idea into action. A creative entrepreneur has an idea for a product or service that will satisfy a desire or need of the public. A careful business plan is developed and, if viable, can move forward. Resources are then allocated to acquire the materials and people needed to bring the idea to fruition. Larger companies that employ a lot of workers get a great deal of attention. However, the majority of companies that hire more people in the aggregate are small businesses. They are the driver of innovation and job creation. Technology. Technology has impacted economies since antiquity. The Industrial Revolution transformed nations from mostly agrarian to production of finished goods. The advent of the Internet has opened a new avenue for entrepreneurs to a worldwide market. Technology has also changed the means of production. Robotics have increased the volume and quality of units produced. Increased productivity from the use of technology has made many products plentiful and more affordable. Opportunity cost. How does one use Production Possibilities Frontier to calculate opportunity cost? The Production Possibility Frontier, PPF, is a curve on a graph that illustrates the possible quantities that can be produced of 2 products if both depend upon the same finite resource for their manufacture. The PPF is also referred to as the Production Possibility Curve. If the demand for wine increases and only so much land is available, then the production of cotton on that land must be reduced. The difference between production possibilities and preferences is that PPF is a tool to encourage efficient allocation of resources. Opportunity cost can be illustrated by using production possibility frontiers, which provide a simple yet powerful tool to illustrate the effects of making an economic choice. A PPF shows all the possible combinations of 2 goods or 2 options available at one point in time. In simpler terms, if you choose one thing, you deny yourself the other. The highest valued alternative foregone is the opportunity cost of the option chosen. If you only have the resources to make widgets, the opportunity to make cogs is lost. The production possibilities frontier is the boundary between those combinations of goods and services that can be produced and those that cannot. Making efficient production choices expands future production possibilities. A production possibilities frontier, or PPF, defines the set of possible combinations of goods and services a society can produce given the resources available. Choices outside the PPF are unattainable, at least in any sustainable way. The choices inside the PPF are inefficient. Sometimes the PPF is called a production possibilities curve. On the PPF chart, opportunity costs increase and the production possibility frontier bows outward because resources are not equally useful in all activities. The law of diminishing returns holds that as additional resources are devoted to producing a good, the marginal increase in output will become smaller and smaller. How does specialization in trade expand production possibilities? The more workers focus on one task, the more efficient they become at this task, which means that less time and less money is involved in producing a good. Or put another way, the same time and the same money allows for the production of more goods. What is meant by economic institutions? When economists use the term institution, they mean property rights, honest government, political stability, dependable legal system, and competitive and open markets. Why are these considered important for an economy? They create the right environment to allocate scarce resources. Conclusion. Depending on the endeavor, some factors have a greater impact. Labor is a key factor in the service industry as well as engineering and software development. Land is more important to agriculture and natural resource extraction. Individuals and large enterprises need to monitor these factors, and their importance can change in shifting environmental conditions. Capital and entrepreneurship. Capital is not only the revenue produced by an enterprise, but also the physical assets, savings, and investments that follow. Managing an efficient and profitable organization is job one for any manager. Protecting and growing the financial stability of an organization is equally important. Product development takes capital, as does infrastructure expansion and marketing. Having the capital to take advantage of opportunities can ensure an organization's viability and sustainability. The lack of capital could lead to a competitor taking your market share. Entrepreneurs often struggle to raise the capital needed to launch a new idea. The sources for small businesses are typically savings, loans, friends and family, and investors. There is also the Small Business Administration that offers grants and loans for startups. Entrepreneurial capitalism. The free market is an effective way to transform savings into profit-bearing investments. An individual can start with an idea and little more to rise above their circumstances. Imagine a woman somewhere on the grassy plains of Africa. She walks into the tall grass with a sharp stone cuts it to length. Then she weaves sandals and baskets to offer to travelers. She sets up shop at a crossroads and trades her wares for things she needs. If there is a demand and the trade is of value to both parties, she can slowly lift herself out of her present condition. Without entrepreneurial activity, capital is just a heap of capital goods. Without the entrepreneur, capital is dead. Entrepreneurial activity is what activates the power of capital. The need to acquire, generate, save, and invest capital is a constantly changing endeavor. One must not only be attentive, but also agile. One must pay attention to the industry trends, the market, and external forces acting upon them. When opportunities present themselves, a well-prepared business owner can take advantage of it. When a downturn is expected, a good manager should be prepared to weather it. Failure to do either can result in insolvency. Savings are of little use if managers do not know how to apply them when needed. Investments can dwindle if managers do not remain vigilant. Monetary and real capital. Capital garnered by goods or services are transitioned to operating capital, savings, and investments. Some investments are in the form of research and development of new products. They may also include improved technology and means of production. As an accounting tool, capital is the monetary representation of real capital goods in the process of production. Production is remodeled by entrepreneurs to address changing conditions in labor and production techniques. It is this activity that transforms capital goods into a profit-earning enterprise. Capital left dormant in savings will not yield enough return to offset inflation. Many retirees discover that after years of savings they do not have enough to sustain their current lifestyle, and many must make concessions. It is the entrepreneur that can take capital and have the opportunity to increase its return beyond those of a traditional savings account. Such endeavors come with risk, and this is why so many businesses are started by younger people. They are less risk-averse since they have many earning years left to make up any losses. Financial capital. Individual and institutional investors in the stock market are in essence betting on someone else's dream. The stock market does provide investment capital to publicly traded businesses. It is also true that over a 100-year average, you are better off in the stock market than in a savings account. Like starting a business, the stock market comes with considerable risk. The first being is that you are not the manager of the company and you have little to no control of its operation. External factors also play a part in the fortunes of a stock. Boeing once traded for $435 a share until 2 of their new planes crashed and the stock tumbled to $136 per share. Social Security contributions made by currently working individuals are consumed by currently retired individuals. This, coupled by the cost of bureaucracy to administer it, one can easily see why most Americans feel there won't be any funds when they retire. What counts for the level of wealth in the time to come is the future stream of income that results from the profit-generating entrepreneurial activity. Savings. For a nation to prosper, entrepreneurial capitalism must be encouraged. It inspires innovation, creates jobs, and increases the tax base. The tax base can then provide better services to the people. Continued wealth creation ensures a vibrant economy and opportunity for anyone to change their condition. Savings are a mere inflow of this economic activity. In the proper hands, savings can secure a future for the organization by being ready for change. A company that is experiencing high productivity and profits should not assume that it will always be that way. Capital maintenance is the act of savings and investments hedge against an economic decline. During COVID-19, so many businesses closed their doors. They did not have the savings to hold out until the lockdowns were lifted. Without a steady stream of customers daily, they did not have the needed capital to maintain their obligations. Savings, investment, and economic growth do not always indicate a healthy economy. In 2006, people were making money on their real estate and financial investments. By 2008, the policies of Senator Barney Frank at Fannie Mae and Freddie Mac had destroyed the real estate market. Likewise, the lack of stewardship of Senator Chris Dodd, who failed to oversee the Securities and Exchange Commission, SEC, resulted in a lack of confidence in the stock market, and the financial crisis ensued. One must be vigilant and well-informed to navigate the economic storms created by external forces. Economic growth requires more than savings and investment. Improved technology alone is not enough. Only when the saving can get into the hands of companies that adapt to market conditions will investment contribute to future prosperity. The entrepreneurial quality of the management and the overall socioeconomic conditions determine whether the savings are put to proper use or squandered. Economic development is only in part a matter of saving and investment. These are necessary conditions. What counts is the entrepreneurial capacity. Conclusion. This overview has addressed the problems of microeconomics such as monopolies, volatile prices, irrational behavior, unemployment, inflation, trade deficits, and exchange rates. Also discussed were the 4 factors of production: land, labor, capital, and entrepreneurship. How technology has impacted production and access to new markets were analyzed. Entrepreneurial capitalism, monetary and real capital, financial capital, and savings were examined. The analysis of these topics leads one to conclude that competent entrepreneurs with sound business plans need access to investment capital. The economic activity of small businesses drives innovation and brings energy to a community. Small businesses are responsible for the majority of new jobs created. Without small businesses, the buying public would have fewer choices, fewer providers, and higher prices. Small businesses become initial public offerings, IPO, on the stock market, allowing individuals and institutions the opportunity to invest in emerging trends and new technology. Profitable enterprises increase the tax base. That helps municipalities provide services to its citizens. An employed population is less reliant on government services. Employment helps restore the pride and dignity of a person, and savings offers a sense of security and well-being. The need to be well-informed and vigilant was discussed. One must be aware and informed on the ever-changing economic conditions. Entrepreneurs must monitor market conditions, competitors, regulatory constraints, and other external forces. Being prepared for opportunities or downturns means managing now for the possibility of either. The task of the entrepreneur is to adapt to new capital formation through the production process to provide the flow of goods during all market fluctuations.